Hey everyone, Eric here. In this video, I'm going to be explaining to you the stages of startups and breaking down the fundraising lifecycle. By the end of this video, you will have a great understanding of startup fundraising and what are the milestones starting from early stage startups all the way through late stage up to IPO. Okay, let's get started. So the first thing I just want to mention really quick is that most startups are actually bootstrapped, meaning they're funded by the founders, that the founders can get them to break even or profitable without any outside investors. And you don't really hear about these companies because there's no splashy fundraising rounds, but many, I would say over 90% of startups and small businesses are just bootstrapped by the founders. So this is a great avenue to go down. If you want to bring in outside capitals, particularly from venture capitalists or angel investors, they're going to be expecting you to try to build like a $1 billion company plus in terms of value in a very short period of time. So you need to know that that's has to be the business strategy rather than if you own the business 100% yourself, you can grow sometimes at a slower rate, but you have a very different business on your hands and you could have a different type of team, different type of lifestyle, et cetera, et cetera, et cetera. So just good to know that there are multiple avenues to go down and that the privately funded businesses are underrepresented in the media. Okay, so I'm going to give you some sort of general guidelines and ranges for what types of fundraising activities are necessary for startups at different sort of growth stages. But I just want to let you know that there's always exceptions to every single rule, and startups are all about exceptional companies. So these are just some very rough sort of context so that you can kind of get oriented when you're seeing things in the news or if you are working with a startup to kind of have some expectations. And the last thing I want to say is that the market for, private investing and public investing as well will drive these numbers up and down. So these numbers can swing around wildly, but these are some kind of general guidelines for a sort of a reasonable market. Okay, so phase one of most startups is basically the credit card, founder savings, have no money, scrappy phase. So your investors are usually just the founders, maybe friends, maybe credit cards, any way you can get money. That's generally no savvy outside investor will invest in your business because generally you don't even have a product at that time and you're just trying to get the basic idea off the ground. So probably the investment vehicle at this stage is debt, like if it's on a credit card or if you don't have enough savings, if someone lends you money, you probably need to pay them back. Let's say maybe you have a strong track record if you're a founder. Maybe someone will actually invest in your business on a convertible, meaning like a safe or something like that. And we'll dive into what a convertible is here in a second, but I'm just going to finish this sort of round. Amount raised at this sort of stage of no product market fit, no minimum viable product is, I have no idea. Any amount, not very much. Traction is generally none. Valuation is, if someone was putting money into your company with a valuation, it would be very, very low. So the first thing, we're going to start talking about convertibles and equity. And I want to just sort of dive in really quick to what is a convertible, what is equity. So if you don't already know this, in early stage rounds, so like pre-seed, seed, so early stage startups, generally you are raising money on something called a convertible note. And a convertible, well, it's usually a safe, but a convertible in general is a type of debt. It has interest. You have to pay it back. But the idea is that you will convert this debt into equity if you do a fundraising round where you sell new shares of the company or the company is acquired. So if that does not happen, meaning someone invests, gives you $100,000, if you don't do your Series A, you actually need to pay them back. But if you raise your Series A, you basically convert what they put in to shares. And so it's kind of this interesting type of security. And Y Combinator, which is like one of the biggest startup accelerators, at least in the US, invented a convertible that basically isn't debt. It doesn't need to be paid back, so it's a little more founder friendly. But it still converts to equity whenever you raise a priced round or have a liquidity event, etc. And why would you do this instead of like pricing shares in your company? Because a convertible, you can raise money on a convertible. It's like a 2 to 3 page document. You don't need any lawyers. And there's only a couple terms you need to agree to with an investor. One thing is that the shares will convert at a certain valuation cap. So you can say, hey, I'll give you, $100,000, but you have to convert my shares at a 2.5 million valuation. So if you go out and you raise money at a 50 million valuation, you have to convert my shares at a 2.5 million valuation. So it protects them. It allows them to basically invest with a valuation cap. But the downside to actually pricing shares and selling them is it's like a 300-page document, really expensive, tons of lawyers. So, if you're a really early stage startup, it's terrible to sell price to equity. So this is generally what businesses are raising money on. And the Y Combinator actually invented the SAFE, and they have the SAFE documents for free on their website. I'm going to include a link in the description below. If you're a founder raising money, just go to their website. Just need to change the valuation cap for yourself, and you can use that without having to pay any lawyers. So let's kind of go back now. So pre-seed, seed startups. So this is sort of anything before your Series A, but at this point you have some kind of a product. So the investors generally around this phase are angel investors. Some VCs do really early stage investing, but VCs like to cut bigger checks. And when your business is really small, it's the more typical investors like an angel who'll cut a $25,000 check or maybe even up to like a $250,000 check, but smaller investors. So you're basically negotiating term sheets with these investors with convertibles, usually using the SAFE. The amount raised, usually you're raising like $1-2 million. Sometimes you see seed stage companies raising like up to $10 million, but they generally would have to have like quite a lot of traction to be able to do that. In order to sort of raise any money, you definitely need some kind of users and some kind of revenue. One thing I just want to mention is that if your business isn't a business that's going to generate revenue right away, like if it's some kind of like science or like deep tech business, then that's an exception, and that's like a totally different category of what type of traction do you need. Like those investors are looking for certain milestones, etc. The valuations generally for like pre-seed, seed, anything from like a couple million up to 50 million if you're raising one of these bigger seed rounds. In terms of like total company valuation, sort of depends on the metrics. Then when you move into the Series A, generally you're going to raise equity. So all your convertibles and your safes are going to convert to equity, and then you're going to usually be bringing in a traditional VC. They'll sit on your board. They'll want to write a big check. They will want to buy 10-20% of your company. It's a very different type of investor. They're not necessarily rooting for you in the same way that maybe an angel is. They are going to be a lot more disciplined, require more information, but they're going to help you, organize your board, make sure you don't have any legal issues. And so they're going to be probably a little more active in terms of best practices for your company. So because they're going to be owning a much bigger chunk of your company, so they want to know that everything is in good shape. Usually to raise a Series A, Series A's are usually at least $10 million raised. So you need to have some good traction. So like if you're a revenue generating company, that's probably like at least $5 million of annual revenue, maybe more. And valuations are sort of like 50 to 100 million roughly for a typical Series A, and you're selling like maybe 10-20% of your company. So once you get past the Series A, this is kind of when you start getting into more later stage startups. So B, C, D, E, F, G. Some startups just keep raising and delay going public for a very long time. These are usually VCs. Your angels can sort of appear anywhere, angel investors, and then you have these investors called crossover investors. And so these are people that like to do late stage investing because they're expecting the company to go public within some period of time. In this case, you're also selling equity, means you're basically issuing new shares of your company and then selling them. So in each subsequent fundraising round, you're issuing new shares. All of the current owners are getting diluted. So if you had 10,000 shares of your company and you want to sell, 20% more, you'd issue 2 million more shares. So everyone would own a slightly smaller percentage after the fundraising round. Amounts raised, this could be any number, like huge rounds like you see sometimes. You could see a Series B that's 30 million, but you could also see a Series B that's, or maybe a later stage C or D that's like 900 million. So this is when you're just sort of raising these huge rounds, like these growth rounds are called. Traction, I mean, you have to have more than when you had a Series A. So you have to be pacing towards a level of revenue that is going to get you to an IPO. Valuations, so probably more than 100 million. But for instance, like SpaceX and Stripe are two basically very large companies that still haven't IPO'd, and they're being valued like around 100 billion. So valuations can range, wildly. And then the final stage of a business, which every startup tries to get to, is some sort of exit, meaning all of the current shareholders get liquidity, meaning someone buys their shares from them. So that's generally for the best company, that's some kind of IPO or public listing. But for the majority of companies, that's like an acquisition, meaning a larger company comes and they buy you, or like a private equity fund buys you, something like this. So if we talk about IPOs, acquisitions in particular can happen anytime. Like you could be acquired at around a Series A, seed, Series B. Acquisitions can sort of happen at any point. Sometimes if the business starts not doing well, they can be acquired. Or if the business is doing really well, a big company can come in and acquire them because they want that sort of exploding business to be part of their platform. Like Instagram, for instance, like when Instagram was growing their users, like Facebook bought them right away for $1 billion. And I think they only had a team of like 10 people. So a startup can be acquired at any time, but IPO is the sort of exit for the biggest startups. So usually in the IPO itself, it's like a late stage fundraising round where your shares start floating on the stock market immediately. So generally you'll raise like 250 million up to $1 billion. So that'll be like kind of your last fundraising round or one of your last ones, if you're not profitable by that point. And a lot of businesses are not profitable when they IPO. Generally, you'll need to be at least $50 to $100 million at a minimum to IPO, and you'll need break-even visibility. So when you're going public, you'll need to say, hey, we're doing $100 million, our revenue's doubling, and we're going to be break-even within the next 18 months, say. So that is kind of an important moment to be at to sort of go for an IPO. And valuations are usually north of 1 billion, although some of these mega startups have been having IPOs at 10 plus billion valuations, or even 50 plus, like a Coinbase or an Airbnb. Like some of them are going public at like north of 50 billion even. So when the exits are so big, VCs are searching for that next company, because a $1 billion exit used to be really big like 10 years ago, and now it's like $100 billion exit is the big exit. So the needle has moved quite a bit. First thing, I just want to say, if you're finding this content valuable, please subscribe to my channel right now and like this video. And if you want me to teach you everything I know about finance for startups in a small group with personalized support from me, please join the waitlist in the description below for a chance to join the next cohort of my training program, Finance for Startups. Okay, so I want to go through a quick exercise now that I told you a little bit about convertibles as well as equity. If you're raising money on a convertible, so like a SAFE is a type of convertible, you might say we're raising money on a $12 million pre-money valuation. Or you would say we're raising money on a $12 million post-money valuation. Well, this is really, really important, the distinction between those two things. And so I want to talk a little bit about what this means. Pre-money versus post-money. So if someone says, okay, we're raising $10 million on a 100 million valuation, or at a 100 million valuation, is that pre-money or post-money? Well, the truth is you actually have no idea unless they explicitly say it. And so you need to ask that question because the outcomes are pretty different. So if we're raising $10 million at a $100 million valuation, pre-money is basically the valuation before the new money gets put in. So if you're raising at a pre-money valuation, basically it's 10 million. And your post-money valuation means it's your pre plus the money that's getting put in. So your post-money valuation is your pre-money valuation plus the new money that's getting put in. So if you're raising at 100 pre, your post-money valuation is 110. So if someone says we're raising at 100 million valuation, it's really important if it's pre or post, because if it's pre, you basically need to issue 9% more shares. So there's going to be, for any existing shareholders, a 9% dilution in the company. But if you're raising $10 million at a 100 million post, well, in that case, you're raising 10, but the total valuation is 100 million after you put the money in. So, it's just important to know that 50 million pre versus 50 million post, it's actually the 50 million pre is a higher valuation than the 50 million post. So it's good to know that when you're thinking about convertibles or priced equity, the pre-post sort of idea applies to everything. Okay, so I hope this all gave you some perspective on startup funding stages, VC exits, etc. Obviously, I sort of oversimplified certain things, but if you want me to teach you everything I know about finance for startups in a very small group with personalized support from me, including a much, much deeper curriculum around fundraising, please join the waitlist in the description below for a chance to join the next cohort of my training program, Finance for Startups. And as always, in the description below, you can download this Excel file completely for free. And if you found this content valuable, please like and subscribe. Only 10% of the people that watch my channel actually subscribe, so please subscribe. Thanks for watching, and I'll see you in the next video.